Welcome to Property Report UK, your trusted source for clear, independent analysis of the British housing market. If you care about where property policy is heading, how tax changes affect real people, and what it all means for the future of renting and retirement in this country, you are in exactly the right place. Tonight's report tackles a subject that has been quietly building beneath the surface of the market, a shift that could fundamentally reshape the role of private landlords in Britain. For decades, property ownership was promoted as the responsible, almost traditional path to financial security. But now, a combination of tax reform and regulatory overhaul is prompting serious questions about whether that model still works. Let's begin by revisiting a familiar story. For nearly 40 years, the British middle class was encouraged to think of bricks and mortar as the ultimate safety net. If you were a teacher in Manchester, a nurse in Birmingham, a self-employed electrician in Kent, or a small business owner in Leeds, the message was consistent. The state pension alone would not deliver comfort in later life. Equity markets were unpredictable. Corporate pension schemes could be altered or closed. But property was tangible. Property was dependable. Property was British. The idea was simple and powerful. Work hard, save diligently, sacrifice where necessary, put down a deposit on a modest second home. Let the rental income gradually cover the mortgage. After 25 years, the debt would be cleared and the property would provide a steady monthly supplement in retirement. Not extravagance, just stability. Heating bills covered, council tax paid, a modest cushion against inflation. This wasn't a fringe strategy. It became mainstream thinking. Successive governments, including those led by the Conservative Party and later by Labour Party, maintained policies that made buy-to-let investment accessible. Lenders offered tailored mortgage products. Tax rules allowed landlords to deduct mortgage interest as a business expense. For many households, this felt like a rational extension of the British tradition of property ownership. But over the last decade, the landscape has shifted steadily at first, then more dramatically. The turning point for many came under former Chancellor George Osborne. His introduction of Section 24 of the Finance Act fundamentally altered how landlords were taxed. Instead of deducting full mortgage interest before calculating profit, many landlords found themselves taxed on turnover rather than true net income. In periods of low interest rates, the impact was manageable. But when borrowing costs began to rise, the arithmetic became more uncomfortable. And borrowing costs did rise sharply. Following post-pandemic inflation pressures, the Bank of England increased base rates at a pace not seen for years. Buy-to-let mortgage payments surged. For highly leveraged landlords, monthly margins narrowed or disappeared entirely. Now, further tax changes are under discussion and, depending on final policy design, could significantly alter effective tax burdens on rental income. Reports suggest that under certain proposals, higher-rate taxpayers could face combined effective rates exceeding 40% on rental profits. While details continue to evolve and formal legislation is still subject to parliamentary scrutiny, the direction of travel is clear: property income is being treated differently from earned income. The current Chancellor, Rachel Reeves, has indicated a focus on fairness within the tax system and the need to stabilize public finances. The Treasury argues that revenue measures are necessary in a period of fiscal constraint. Critics, however, warn that if rental income is taxed at significantly higher effective rates without full expense relief, the incentive to remain in the private rental sector diminishes. And that brings us to the second major development: tenancy reform. The proposed Renters' Reform Bill, widely debated across Westminster, includes the abolition of Section 21 no-fault evictions. For tenants, this represents increased security and protection from sudden displacement. For landlords, it changes the risk profile of letting property. Regaining possession would rely more heavily on specific grounds under Section 8, which can involve court proceedings. Here, practical concerns emerge. County courts in England and Wales already face substantial backlogs. Industry groups argue that without significant investment in the court system, possession cases could take many months to resolve. During that time, landlords remain responsible for mortgage payments, maintenance, insurance, and compliance regardless of whether rent is being paid consistently. Put these strands together: higher effective taxation, rising mortgage costs, regulatory reform, and slower possession processes, and you begin to see why some landlords are reassessing their position. Estate agents across parts of London, the Midlands, and the North West report increased listings from long-term landlords choosing to exit. Data from industry bodies suggests that smaller portfolio owners are disproportionately represented among sellers. This is not necessarily a collapse, but it is undeniably a shift. The implications extend beyond landlords themselves. If a significant number of private landlords leave the market, rental supply contracts. Basic economics tells us that when supply falls and demand remains strong, particularly in cities with population growth and limited housebuilding, upward pressure on rents follows. We are already seeing record average rents in many regions. Tenants face a paradox. Reforms designed to improve security may, in the short term, reduce available stock. Meanwhile, institutional investors and large-scale corporate landlords, often operating through limited company structures, may find the new framework easier to navigate. Unlike individual landlords taxed at personal income rates, companies pay corporation tax on net profit and retain flexibility in how profits are distributed. This raises a broader question about the future structure of the UK rental market. Are we witnessing a gradual transfer from small private landlords to larger institutional operators? If so, what does that mean for pricing, tenant experience, and local accountability? It is important, however, to maintain perspective. The UK housing market has weathered numerous reforms before. Stamp duty changes, the introduction of the 3% surcharge on additional properties, tighter lending criteria, energy efficiency requirements each sparked predictions of collapse. Yet the market adapted, albeit with winners and losers along the way. What feels different now is the convergence of pressures at once. Higher interest rates compress margins. Tax reform reduces relief. Regulatory change alters risk. Court delays extend uncertainty. For a landlord who purchased in 2005 with modest leverage and low borrowing costs, the environment of 2026 looks radically different. Consider a simplified example. A landlord collecting £1,200 per month in rent with a mortgage costing £900 may appear to generate £300 in monthly surplus before maintenance. But if tax is calculated in a way that limits full deduction of interest, the taxable figure could be significantly higher than the real cash profit. When marginal tax rates approach or exceed 40%, that discrepancy matters. This is where strategy becomes critical. Some landlords are exploring incorporation, transferring properties into limited company structures to access corporation tax treatment. Others are reducing debt exposure by selling selected assets. Some are exiting entirely and reallocating capital into diversified investments such as ISAs or government bonds. Each route carries costs and consequences. Incorporation can trigger capital gains tax and stamp duty liabilities. Selling into a market where multiple landlords are listing simultaneously may affect achievable prices. Holding on requires confidence that long-term rental growth will offset near-term pressure. Meanwhile, tenants watch anxiously. For those renting in high-demand urban centers, fewer listings mean tougher competition. For aspiring first-time buyers, increased landlord sales could expand supply in the owner-occupier market, but only if prices adjust to accessible levels. Policy makers face a delicate balancing act. Strengthening tenant rights addresses genuine concerns about security and standards. Ensuring fair taxation supports public finances. But unintended consequences, reduced supply, higher rents, market consolidation must be monitored closely. The story unfolding is not one of villains and victims. It is a complex recalibration of incentives in a housing system that has long relied on private individuals to provide rental accommodation. The question is whether the new equilibrium will deliver stability for both landlords and tenants, or whether we are entering a period of prolonged volatility. For viewers of Property Report UK, the takeaway is clear: the buy-to-let model that dominated the early 2000s cannot simply be assumed to function unchanged in the late 2020s. Risk profiles have evolved. Policy risk, in particular, now sits alongside market risk. If you are a landlord, the coming months are about numbers, honest, detailed cash flow analysis under realistic assumptions. If you are a tenant, understanding how supply dynamics influence rents will be crucial when negotiating renewals. And if you are considering entering the property market for the first time, awareness of this structural shift is essential. As always, our aim here at Property Report UK is not to inflame but to inform. We will continue tracking developments from the Treasury, monitoring announcements from the HM Treasury, analysing statements from the Bank of England, and reviewing how legislation progresses through Parliament. Because in housing, policy decisions made in Westminster echo through living rooms, letting agencies, and retirement plans across the country. If this report has helped you understand the forces reshaping Britain's rental landscape, make sure you stay connected. Subscribe to Property Report UK, hit the like button if you found value in this analysis, and turn on notifications so you never miss a market update. We break down the headlines, examine the numbers, and explain what they mean for real people without hype, without spin, and without political slogans. Thank you for watching. Stay informed, stay prepared, and join us next time as we continue to track the future of the UK property market right here on Property Report UK.